We want to create a strategy that no matter how bad our trade is, we always get out with a profit. See, it is not your ability to manage good trades that makes you a good trader. It is your ability to manage your bad ones. That's what makes you an excellent trader.
The topic of today's seminar is the Forex DAT strategies. We have several different strategies that are running on our software, and I'm going to focus on the ones that actually I'll bring the, hopefully everybody can see this. What we're going to do is talk about these strategies. We are currently broadcasting, for the lack of a better term, 8 different strategies that we're currently running for the public to see, and the purpose of these displays is really give everybody an idea of how the software works, the mechanics, the logic, algorithms that we're using to run the software in the background. And I'm going to dive into each one of these individually and explain how they have been built and what the strategy is all about. Again, I would like everyone to please read this disclaimer. What we're trying to display here is the mechanics of what the software does and how it works. We're not necessarily focusing on the actual results. The results obviously will vary from account to account because each and every account, it trades independently. Even though you might be running strategy number 1 same way as 10 other people, but every other person has will have a different result simply because their point of entry into a trade, into the initial trade, is different from everybody else. And then the algorithms that are created as a result of that point of entry will be obviously different for everybody else. So let's jump into the first strategy that we're showing. And what I'll do, I'll go ahead and open my viewer. Actually, I'll do it from over here. Here's the dashboard or main window. We started running this strategy back on July 28, 2013. So obviously, it's been running a little over a year. Started with a $100,000 account. And basically, let's jump in and see what is going on. I'll move this aside. Okay. The first thing we want to look at is the harvester. And we see that the symbol that is being employed here is pound yen, where, again, we started on July 28, 2013. The initial balance was $100,000. And this is a fairly high risk strategy, being that we do not use our proprietary zone recoveries or trade recoveries, where this is purely a hedging play, hedging strategy. When a trade goes against us, then an opposite trade, we call it the hedging harvester or hedging trade, is open. And the strategy has several harvesters, and those harvesters open at different pip intervals, meaning that the market has to move a certain direction in order for the hedging trade to be open. We can also look at the advanced algorithms that are being employed here. There's several dozens of them. I'm not going to go into the details as to what each and every one of these algos does. Suffice it to say that each each one of these advanced settings is based on a certain event in the market, and that event calls out an action. Some of these actions are contingencies only, meaning that a certain condition has to be present in order for the algorithm to be activated. So we've got the advanced management setup. This is a very much trending strategy that is based on the market strength. These are contingencies. Market strength has to be present, as well as certain direction of the market has to be present. In fact, what you're looking at on the TS matrix window here is this is 13 different arrows, and 60% of these arrows have to be synchronized. So in other words, go in the same direction, or else the strategy will not trade. It will wait until this condition is present, at which time trades will be open. Going back to the harvester window, we have several algorithms that open a euro-yen trade. Several algorithms buy euro-yen. Several algorithms will be selling euro-yen. Now, again, as I mentioned earlier, there are no trade recoveries with this particular strategy. Therefore, it is considered fairly risky in the sense that the trades can run away from you if the market reverses dramatically. And why I say that? Well, because the strategy is based on trending and market strength, and sometimes these indicators will be delayed. And during that delay, before the software can actually determine that the trend has changed, the market can run 300, 400, 500, 600 pips, and that could leave some of these trades exposed. So anyway, let's look at some of the results that we've had so far. I'll go into the closed deals. There's the closed deals window. I'll look at the history process. It takes a little while to populate this window because there's a lot of data going all the way back to July 2013. That's well over a year now. And so we see that we basically closed a total of roughly about 66,000 of winning trades. If we want to look at how many of those were profitable, then I will highlight all of this all the way down to about there. So we had a total of 1,624 trades profitable out of 2,655 total. So that's a pretty good percentage. There were some that were just break evens, and as far as the losing ones, all the way down, a total of 1,021 trades that were losers. We don't really care about that because those are for the most part of a trading sequence. Every trading sequence becomes a winning trading sequence at the end of it. Now, looking at the open deals, the open currently we're about actually we're not even in a drawdown. We're about $500 in the plus on the existing trading sequence, even though the total net of all the trades that are open is minus 2,500. We only need $1,489 to close all deals, close this existing trading sequence, and at that time we will have made $2,000. So if we only need $1,500 to make $2,000 total, we've already made $500. As far as what the broker is showing, and I'll bring this here. The broker is showing right here $162,600 plus another roughly $700 in floating. So that's about $163,000 balance. So that's a total of give or take 63% for the period that this strategy has been running. It was at certain times in drawdowns. Currently, it is not. I hope to find one of these other strategies that are currently in a drawdown, because I want to explain exactly what it means to have a drawdown. This is currently looking pretty good, but again, keep in mind we're not trading the most volatile symbol. We're trading euro yen, as opposed to our favorite pair that we currently trade, which is pound yen. Euro yen's not going to move as much, but keep in mind there is no trade recovery. The trade recoveries are actually being created by additional trades when the market reverses, and those trades are, number one, hedging, and then trading in the opposite direction. Also, if you look at some of our other description, the longest drawdown, which is a period between two trading sequences that were profitable. So the longest period without a profit was 87 days, is what I'm trying to say, and that was between February 11th and May 9th, 2014, just earlier in the year. So let's go ahead and jump into strategy number two. Strategy number two, we started it not too long ago, June 15, 2014. This strategy is not for the faint of heart, because it is rather aggressive. Actually, not rather. It is very aggressive, and it performs well in range-bound markets. It performs not as well in training markets, but because of its aggressiveness, there is a very high risk to reward relationship here. We started June 15th. I apologize. We were as many as 85 days without profit between 6/17 to 9/10. That's 85 days, almost 3 months. And let's look at how the strategy's built. Here we are. That's Forex dat number 2. Let's look at the harvester setup. There's a lot, as you can tell, there's a lot of algorithms, a lot of them. We're trading our favorite symbol, pound yen, here. This strategy is based on what I refer to as my Renko trading protocol, and I'm not going to go into the details exactly what it is. The trades that are being opened by these individual algorithms are all based on on movement in the market. This is not a trend-based strategy. In other words, the software or the algorithms don't really care which direction the market is going, what the sentiment is, or what the trend is. The trades are open purely on price action. When the price moves, as you can tell right here, this is the starting price. When the price moves 20 pips, 30 pips, 40 pips, 50, and 50 pips from the starting point where we're at. As you can tell, looking at the status column, most of all harvesters are running. They're either running or triggering. Triggering means that they're getting ready to run. They're getting ready to place trades, and they're waiting for the proper conditions. And the proper conditions will be when the market has made the necessary move for the trade to be placed, or for the harvester to start up. Again, we started this strategy back June 15th, and currently we're at about $103,000. So bottom line is, don't really pay a big attention to the return. You know, some people will look at it and say, oh, well, that's you know, just incredible, over 100% return in less than half a year. However, it is a very, very aggressive strategy. In fact, we started trading this strategy with $50,000, and if you notice, the size of each trade here is actually one full standard lot, or 10 mini lots. Typically, we will trade a $50,000 account with half of this size. So this strategy is running at double the speed that we would normally want the strategy to run. What we're trying to do here is simply demonstrate the mechanics of the software at an accelerated level. What I do want to do is go back and explain the parameters, or the logic behind the strategy. As you can tell, most of the harvesters, most of the algorithms are either running or they are triggering. That means that each and every algorithm is ready to deploy at any moment when the market makes the necessary move. This means that you can have an awful lot of trades happening at the same time. If we look at the global open deals window, these are all the trades that are currently running. In fact, I don't have enough space on my screen over here to show you all the trades that are currently open. Now, what we're looking at is currently there's minus 133,000 in negative trades. However, the drawdown is only about $17,000. That means that there's about 115,000 or so of trades that have already been put into the closed deals window. So whatever the largest drawdown was during this trading cycle, the software is trading out of it until obviously it completely bridges the gap between our profit, and the profit is only set at $500, which is really 1% of the account that we started with. And this really shows you the aggressiveness of the strategy and the fact that it really trades a lot. There's a lot of trades. We've got a total of 69 trades open. In fact, we out of a $103,000 account, we have only about $25,000 worth of equity left. If we were trading a smaller account than we are, then we're running the risk of running out of margin, at which time not all of these trades would be possible. That is why I'm saying this is a very, very aggressive strategy, and one needs to use an awful lot of caution. In fact, we would not recommend anyone, unless they are tremendously experienced with the software, we wouldn't recommend this setup for a beginner user. We would recommend it to be cut down in half in terms of the initial trades being placed, because then you just cut everything in half. Yeah, you wouldn't make 102% in 5 months. You'd make only half of that, but you know what? I think that's very very respectable. So we've got an awful lot of trades. In fact, the cycle started first trade 10/2 October 2nd. So we've been in the cycle for some time now. I said initially that this was a strategy that works well in a range-bound market. Recently, we have experienced a market that is very much trending. That is why we are experiencing this type of a drawdown with this particular strategy. Now, you guys please understand that most of the money in any capital market is made when the market trends, when it moves. when it goes up, down, up, down, up, down, up and down, up and down. You're not really, you're kind of stuck in a range, and you're treading water. You're not making a whole lot of money. You might be opening a lot of trades, but it will take time for those trades to close out, as we can clearly see in this particular setup. And I'm actually glad that it is the way it is, because it gives me an opportunity to really explain it. The idea of the algorithms and of the trading sequences that the software creates as a result of these harvesters is that if the market goes against your trade, and it inevitably will, in fact, it probably will most of the time, then there's other ways to recover from that losing trade than to take a loss, which is typically what retail traders do, or what they are or have been taught to do. Well, if the market goes against you, cut your losses quick. Well, we don't necessarily believe in that theory. We don't like to have losses. Don't get me wrong, but we think there is a better way to do this than actually take a loss. We will deploy additional algorithms or additional trades, and every trade in this particular strategy has a trade recovery built in, and you can clearly see that from the size of some of these trades. You see that the initial trade starts off as 10 mini lots or one standard lot, and then there's different sizes. And in fact, if I were to sort my harvester ID column by the number, then you see that, for example, harvester number 85 has 4 trades open, and they vary in sizes, as you can tell. Similarly, you've got harvester 90 that has 2 trades in here. Then you've got going down here, you've got harvester 86. Harvester 86 is just a plain trade, original trade of this particular algorithm that doesn't have any trade recoveries running for it yet, simply because there hasn't been any need. The market hasn't run away from this particular trade a whole lot. This trade is down 46 pips, which is no big deal. That's really, in this market, that is nothing. We've got 91, 1, 2, 3, 4 different trades running at the same time. So basically, when the market doesn't want to cooperate, the algorithms that are employed, and you see them listed in the harvester window, but all of these algorithms, they rely and call on each other and help each other one. It's like the orchestra basically playing in unison. So basically, we've got a little bit of a drawdown here, and this is in real time. You can see we went from about a $17,000 drawdown down to about $18,500 drawdown, and you can tell at the bottom here where you have the summary of the positions. Your long trades, the size of your total long trades is 903 minis, and your shorts are 654.8. Now, obviously, this gives you a net long position, and just from looking at this number in the last 5 minutes or so, we can tell that the market has been going down because we're losing ground a little bit here. If the market was going up, then your net position is gaining more than your short position is losing, and that really is the principle of this whole thing. Now, one other thing I want to point out is these green trades. The green trades are basically what we call free positions, and these are trades that have been protected with a protective profit stop. And if the market were to reverse, we will get out with a profit. We no longer need to worry about these trades. They can run on their own. They've been protected. They're in profit. If the market reverses, we'll get out. We'll take some profit with us, and then the software will focus on all these other trades, so on. So we've got longs that are in profit and have been protected, as well as shorts. Now these all will be taken out in time, and the gap between what we need to close in order to close with profit will be reduced. Again, market's going down, but if we sat here for a little longer and watched this, then you would see as some of these shorts, some of these longs with market going down will be taken out with profit, and the short trades will be added, because that's just the natural way the software works. And the profit on some of the longs, if I look at it this way, let's just the biggest profits we have right now are on the longs, but if the market keeps dropping like it has been a little bit here, then the longs will get closed, and the shorts that are actually, this is the most profitable short trade so far. It's down 39 pips. These trades will start getting into profit. So that is the pattern that the software will follow, not just on this strategy, but other strategies as well. All right, so that was strategy number 2. Let's move on to strategy number 3. And here we are. Strategy number 3, we started a while back, about a year ago. Started with $100,000. Here's the progression of that strategy. I think we might be in a little bit of a drawdown on this one as well. It is a fairly aggressive strategy, and this is for the most part a trending strategy. The largest drawdown was, or the longest drawdown was 113 days. So we went almost 4 months without a profit, which is part of the deal. Some people would complain and say, "Oh man, I'm just wasting my time." Well, unfortunately, sometimes it is like that, and it is part of the business. You don't make money each and every day or each and every month. Sometimes you will make half of your money in 2 months, and the other 10 months you're just kind of wasting time. But we take whatever the market gives us. We can't argue with the market. The market does what it wants to do, and that's why we have different types of strategies. Ones that are designed for range-bound markets, some that are designed for trending markets. But overall, when you take a longer view of the market, you will ultimately make a whole lot more money with a trending strategy, even though you might be in flat market. You might be caught in flat markets for a while. So anyway, let's take a look at strategy number 3. That is Forex DAT 3. Here we are. Again, we're trading pound yen, and this strategy has a relatively small number of harvesters compared to the other ones we looked at. I think we've got 10 harvesters here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I stand corrected. 12 harvesters. 6 of them are buying, 6 of them are selling. Each strategy will have a trade recovery that is based on our zone parameters. And right now we're looking actually at the zone recovery setup, and we're looking to start recovering after the market moved against us 200 pips, and then we'll recover the entire position after 300 additional pips of the market's move. We only are using 2 legs simply because adding more legs to this zone recovery could almost resemble a martingale, and we don't trade with martingales. That's highly risky and totally against what we do, even though some people might say, well, it looks very much like a martingale. Well, but we limit it to 2, maximum 4 legs. If I were to do a martingale, I'll just click on this calculate thing, and then the martingale, a 20-leg martingale would put me in a very large trade. The chances are I wouldn't have a large enough of an account to be able to handle this. So we don't really do that. We can calculate the martingale when determining the zone recovery, but we'll just leave it at 2 legs. 2 legs here. So each one of these harvesters has a zone recovery that will recover the trade that is being generated or created by its algorithm. But there's also, besides that one trade, there's 11 other trades that can be run at the same time. Now, we started again. We started November 3rd with $100,000 here. Let's look at the closed deals. What we did so far. So we did about $95,000, $96,000 in profits. Let's take a look at the winning trades. Right there. So out of a total of 281 trades, and again, this strategy doesn't trade a lot. It trades, but not as much as some of the other ones. Out of 281 trades, 236 were profitable, and only about 44 of them were losers. Now, so you can tell that there's a very high probability of having a winning trade because of the way the strategy is set up, and this is due to the fact that it is a trend-based strategy. Every trade is contingent upon the market moving in the direction of the intended trade. We've got a very similar setup as on the previous contingencies, and the important thing of this strategy is that in addition to the zone recovery that we have on each and every trade, there's what we call natural dollar cost averaging, because every 100 pips there's a possibility, if the market still is trending in the direction of the original trade, that additional trades will be added, but no closer than 100 pips away from that original trade or from the second trade. And we've got a total of 6 trades that will come into place and try to improve the cost basis of the original trade. So when you combine that dollar cost averaging, that is 100 pips away from the previous trade or from the closest trade, together with the zone recovery, you've got a fairly tight strategy in a trending market, and in the trending market it will generate a lot of profit. However, in a flat market it will not perform so well, simply because it will not place a lot of trades, and if it doesn't place a lot of trades, there is not a whole lot of opportunity for scalping. In other words, in a narrow range, there won't be enough room, if you will, for the trades to become profitable on such a wide trade interval, because the trades are placed no closer than 100 pips away from each other. So if you have a 300 pip range, as we did during the month, or between the months of April and August, well, the most that you can have, the most number of trades that you can have open in that range is 3. In fact, they're 100 pips apart. In a 300 pip range, you can place about 3 of them. That's about it. So there's not a whole lot of trading going on. Your drawdown is I don't want to say minimal, but it is limited. However, with this particular strategy, look at the size, because we know that the drawdown will be limited. So we can afford to trade a little bigger size than we normally would, right? Normally on a 100,000 account, we would trade 10 minis, which is 1 full lot. But on this one, we're actually trading 30 because there's not that many trades. This strategy doesn't trade a whole lot. So if we look at our open deals, again, we only have a few trades open, but look at this. We're actually in about a 15, not quite, $14,500 drawdown. We have a couple of runaways here, but the software will get out of it. Let's look at the closed deals again. We had the last global close on the 16th. So since the 16th, about 12 days, we've been struggling a little bit, but that's not that big of a deal, because on every reversal, if the reversal happens more than 100 pips away from the original trade, the cost basis of the previous position will be improved, and the software will trade out of any hole that the market might have dug out for it. So going back to the harvesters, we're trading pound yen. The reason why, because we want to capture the volatility of this particular currency pair. We want to capitalize on it in trending markets, and the historical behavior of this particular pair has been very trending. This pair likes to trend. In fact, anything with yen likes to trend, but particular pound, because it's an expensive currency, it does like to move a lot, and that is why we like it. So a relatively moderate risk strategy, we make it a little more aggressive by trading a bigger position. So let's jump into the next one. We've got we've got strategy number 4. We started this one earlier in the year with only a $10,000 account. It is a relatively moderate to conservative strategy. You're not going to get a whole lot of drawdown, and you're not going to break any profit records either. But again, it is it can be profitable. Let's take a look at it. The longest drawdown that we had was only 40 days. Again, it was in that flat market that we experienced earlier in the year, and that's really not bad. That's actually very good. Let's take a look at it. Number 4. We're trading both pound yen and euro yen. We're trading 1 mini lot. 1 mini lot corresponds to the $10,000 account. If we look at our advanced management of these algorithms, then we see that it is very much a trending strategy. We want to capitalize on the market when it's trending and moving. We're looking at about a 21, 22, 23 maybe % profit so far in about 7-8 months or so, and I think that is your very conservative 2 to 3% per month, and we believe that it will stay this way, just on the basis of how conservatively it is designed. Trading 2 pairs, They complement each other. They're both trading opposite of yen, both euro and pound. It is a very good, in my opinion, conservative strategy for the beginning traders. All right, so let's go to the next one. That's strategy 5. Strategy 5 is our longest trending or longest trading strategy. We started that started back almost 2 years ago, and again, $100,000 beginning. We had a 113-day drought where the profit was not made. In fact, we were in a drawdown. I think this drawdown was about 30%, if I remember correctly. And let's take a look at it real quick. Harvester. We're trading both pound and yen. Each strategy is based on a trending algorithm or trending conditions. The market has to be moving in the specific direction of the intended trade, both short and long. Oops. Similarly here, 60% of these arrows have to be synchronized. So definitely the market would be, or the arrows would be predominantly red. Market's going down, as well as the market strength has to be at a certain level. If the market strength is not there, that indicates that really the market is not moving, and we're not going to be going to be trading. Going back to the algorithms, we have I believe 40 algorithms altogether. 10 euro yen buys, 10 euro yen sells, 10 pound yen buys, and 10 pound yen sells. We adjusted the strategy a couple of times, increased the size of the trade as the capital grew, as we were adding profits. Currently, we're looking at about 301,000 in this particular setup, and that's about 201% over the last give or take 22 months. This is one of our most basic strategies. A lot of people have used it over the last 10 months or so since we had the software out. Again, there was a bit of a drawdown in between May and September. That drawdown lasted almost 4 months, but most people, if not all, have gotten out of it and are now in profit. And this is one of those times when actually the market is not cooperating. Again, this is a strategy that works best when the market is trending, and when the market is not trending, then we're going to be sitting waiting for the market to until it starts moving. Now, none of us has a crystal ball. If we knew what type of market behavior we're going to experience in the next foreseeable future, then obviously we would go with the appropriate strategy. But you know, nobody really knows. So not a bad strategy, very effective, has proven itself over time. Even if the market doesn't cooperate, the software, because of the algorithms that it has going for it, has the ability to work out of any hole that the market will create for it. So that's your number 5. Number 6. Okay, 6. Again, zone recovery strategy, very simple strategy, designed for trending markets. However, because of the way the zone recovery is set up, the market really needs to trend for this to perform well. When the market trends, it makes a lot of money. when the market doesn't trend, you're waiting for those times when the market does trend. In fact, if you look at the balance, we've got a fairly large account. We went from 100,000 to 200 in about a year, right? So that's about 100% return on the strategy in a year. But then from 3.7 to 9.18, this is what, six months and 11 days, right? 6 months and 11 days did not do so well, did not do so hot. But you know, it is what it is. You're not going to have a profitable quarter every single quarter. If we did, we'd be in a completely different world altogether. There's just some ways or some markets that are difficult to trade. So anyway, let's take a look. Number 6, what we have specifically here. All right, trending only euro yen, again started back in 2003. The zone recovery was edited earlier this year, and it has a fairly short zone range, only 100 pips, and then it needs another 200 pips to recover. And why is this a problem in range-bound markets? Well, in range-bound markets, the currency goes up and down and up and down and up and down and up and down, and in those situations, there are too many zone recovery trades open. This is a fairly aggressive 100 pip zone recovery is fairly aggressive. And what really happens is that you will have a lot of unnecessary zone recovery trades that will drag you down in a range-bound market. So, you know, if we look at our history of what we've closed so far, about 121,000 in profits. Our last global was earlier in the week. Actually, this is yesterday, I think. And then when the market trends, it will have a lot of global closes. Look at that. But when it doesn't, you'll have to wait. But it is a great strategy as far as I'm concerned, because when the market runs, it's pretty awesome. So you've got only 10 harvesters, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 5 that buy, 5 that sell euro yen. Euro yen doesn't move as much as pound yen, but obviously we want to give people an alternative to pound yen. We've got the zone recovery that we talked about. There's only 2 legs to the zone recovery. We've got the conditions, the contingencies, and basically, if you look at the TS matrix value, and that is the market strength value on the 60, 240 and daily time frame, it's got to be over 44%. So this strategy trades in very, very volatile markets. When the market is moving, it's going to trade. And let's see what we have currently. Currently, we don't have any trades open. We're all out. We're looking at $221,000 balance in the account, so about 121% in the time that we've been trading, roughly about year and a half of or so. But 6 months of that, if you remember, going back over here, 6 months we were in these doldrums where we couldn't get out with a profit until finally on September the 12th, which was last month, about a month and a half ago, right? So good trending strategy. It's not going to draw down terribly because there are not going to be as many trades. If we in the year and a half, we only closed 1,562 trades, which is less than 100 a month. That's less than 5 trades a day. That's not a whole lot. But we're taking good profits on this one. So that's that. Let me jump to strategy 7. Strategy 7. This is probably the highest risk strategy that we have. When the market cooperates, it works very well, and this one, for the most part, is a range-bound strategy. And we actually, if you look at the date, we created this one on August the 3rd in the midst of that range-bound market. It performed pretty well for a little bit, but I think, if I'm not mistaken, it might be in a bit of a drawdown right now. So let's look at it. All right, so here we are. All right, pound yen. Guess what? There is no trade recovery on this strategy. And the reason why there's no trade recovery on this strategy is because it's designed for range-bound markets. In a range-bound market, you don't really need a trade recovery such as the zone recovery, simply because the market's going up and down and up and down within a couple of boundaries, the high boundary and the low boundary. And the market is not going to run away from you if it stays within that range. So you don't necessarily need to be concerned about a trade running away from you. However, when the market starts running, when it turns into, when it breaks out of that range, it can theoretically cause you some headaches, because you have no recovery on those runaway trades, right? So from August 3rd until the beginning of the month, it performed well. Again, no trade recovery. It is let me go back here. It is based on trending. However, it is designed for a range-bound market, and that probably is not necessarily the best selection. But anyway, we're demonstrating what happens when a range-bound strategy gets caught in a trending market. So let's look at our open trades. Wow, we're all of these purple lines that you see, those are orphans. There's hardly any profitable trades in here, and these are the runaways. So we are currently looking at about $63,000. So we're drawing down 40+% on this strategy. I don't recommend this. It is here for you guys to see that not every setup suits every market, and this actually goes to prove that don't use a strategy without some type of trade recovery. It is better to have a trending strategy with trade recovery than a non-trending strategy trying to scalp the market, because sooner or later the market will run away from you, and that's not a good thing without some type of a recovery. So let's just move on to the next one. Not recommended. Stay away from it. We will leave it on for you to monitor and see what happens, so that you have a good idea of the mechanics of the software, how it works. what happens behind the curtain or behind the scenes. And you know, you can monitor the closed trades, the history of it. It will try to scalp the market, but the problem scalping a market in a trending situation or trending environment is that you're scalping a market in the direction of the market, leaving all the opposite trades unattended or unprotected, and the market is running away from you or running away from those trades, and they become hopeless losers, as we can see in the open deals over here. There are some that are obvious runaways. You should not have a trade with a minus 600 pip loss, no matter what you're trading. Okay, so I'll close this out and let's take a look at number 8. Number 8 is our most recent strategy. We put it on as a result of trying to create a hybrid environment. In other words, somewhat find a medium between a range-bound market and a trending market. So this is what we came up with. Again, too early to determine a whole lot of history. Obviously, we've been trading it for what, 3 weeks now, right? 3 weeks. After about a week, we had about a 5.5% profit on it. Well, let's take a look and see what's going on with it today. All right. Now, this is a highly advanced strategy because it actually employs 156 individual algorithms. Yes, you heard me correctly, 156. And each algorithm actually has its own two-legged zone recovery, meaning that the algorithm can create not just one trade, but a total of 3 trades. So you're looking at potential of 460 trades being open at any given time. But this is I mean, I'm stretching it a little bit. This is an extreme here. Let's look at what we've got in the open trades, and what you notice over here that we're seeking a 2% profit, $2,000 on a $100,000 account. But we've got an interesting function in here that says ignore free positions on CAD functions. That means don't execute this function when you've got free positions. And free positions are basically those profitable trades that cannot be losers anymore. We sure have a lot of those, and they're big profits over here. In fact, if you look at the summary bar down here, we have a total of 54 trades that are open for a total of a net profit in all of these trades that are open, $10,335 right now as we speak, which puts us in a minus $8,300 to close all deals, which means that we have exceeded the profit target by $8,300 in this particular trading cycle. So the trading cycle did not close at $2,000, but it kept going to maximize the profits of the trending market, right? And you've got a total net position of the long trades here, 84.5, and total of the short is 62.5, which gives you a difference of 22 mini lots. If we look at the broker right there, it's a long total net long position. Look at the balance here. It is 129,000. Well, that's not bad. 29% in 3 weeks. I would say that's pretty darn good. But what is more impressive to me is not necessarily the profit, but look at this. Our first base trade, our very first trade that the strategy will be placing is one mini lot, one mini, not 10 minis. This is a micro strategy as far as I'm concerned in terms of how much margin it will need and how small the positions that it trades are. Obviously, you can add to those positions, or you can add to your position as the market continues to move in your direction, or if it reverses, then you will reverse with it. But the bottom line is, at the most extreme, your largest initial trade is 5.5 minis, and that for a $100,000 strategy is relatively a low drawdown, particularly the way the strategy set. We quite frankly haven't seen a whole lot of a drawdown here in the 3 weeks since we've been following it. The strategy places an awful lot of trades. There are very small, tiny, minute trades, and the strategy is designed in a way where these individual little tiny mini trades are kicking in to improve the cost basis on the original trade should the market go against it. And because you've got this many tiny trades, it is not very difficult to achieve the global close, particularly when you're not greedy, when you're not asking for a whole lot of profit. Now, in addition, we've got the function where we're ignoring the close all deals when we have these protected positions, and we're allowing the natural course of the market to maximize our profit on those positions. If you were to look at some of these trades, you've got $1,100, $1,200 just on a couple of these trades. Just these two trades are more than enough to close all deals with our $2,000 profit. But why leave the profit on the table when we can try to maximize it? Now, this will only work in a trending market. In a non-trending market, you will obviously get in profit, and then you will probably be trailed out very quickly. And it's still, that's why we call it hybrid, because it can perform relatively well in range-bound markets as well. But trending markets is really where the money is. So we're following this one. We're very optimistic about this latest one. And like I said, today for the first time, it went into a live account. I have a pretty good feeling about this. So that's about it. I think this should give folks a pretty good idea of how we build these strategies and what the logic is that we're following, and what the intention is when we deploy the individual strategies into the market. We look purely at price action, because at the end of the day, that is the only thing that matters. We are looking purely at the price, and we're using the most fundamental and the most basic science known to man, which is called mathematics, and you cannot fool mathematics. 1 + 1 = 2, and it will never change. And that's the basis for all of our algorithms. They are based on nothing but pluses and minuses, and you can't argue with that. You can't argue or dispute math. Whereas the fundamentals and the technicals and all that crap is designed to confuse people and take your money.